Vanguard ETFs, complete guide for Australian investors. Vanguard is one of the most trusted names in low-cost investing, but with over 20 ETFs on the ASX, knowing where to start can be overwhelming. In the next 9 minutes, I'll show you exactly how to read a Vanguard fact sheet, the difference between all-in-one and single-sector funds, what's new for March 2026, and a 6-step framework you can use to analyze any Vanguard ETF. Let's go. Fact sheets plus VAS example. Every Vanguard ETF has a one-page fact sheet. Let's use VAS, the Australian Shares ETF, as our example. First, management fee. For VAS, that's 0.07% per year, very low. Second, income distribution. VAS pays quarterly dividends, mostly franked. Third, DRP. That's the dividend reinvestment plan. Tick the box in your broker and distributions, buy more units automatically. Great for compounding. Finally, the performance table. Ignore the hype. Compare the ETF's 1 year, 3 year, and 5 year returns directly against its benchmark, which for VAS is the ASX 300. If it tracks closely after fees, it's doing its job. All-in-one diversified range. Now, if you don't want to build a portfolio from scratch, Vanguard's all-in-one diversified ETFs are perfect. Think of them like superannuation investment options. But inside an ETF, VDHG is 90% growth assets, 10% defensive, high risk, long term. VDGR is 70 over 30. VDBA is 50 over 50. VDCO is 30% growth, 70% defensive. Vanguard rebalances them automatically. You buy one ETF and get Australian shares, global shares, bonds, and even some infrastructure inside. For most beginners, picking VDHG or VDGR and doing nothing else is a completely reasonable strategy. Core equities, VAS, and VGS. For investors who want more control, the two core building blocks are VAS and VGS. VAS covers the ASX 300. The catch, it's heavily concentrated in financials, banks, and resources like BHP. That's about 55% of the fund. Plus side, fully franked dividends. VGS covers global shares excluding Australia. Over 1,500 companies, mostly US tech. Apple, Nvidia, Microsoft, no franking credits, but you get currency diversification. A classic starter portfolio is 40% VAS and 60% VGS. Simple, cheap, and globally diversified. New March 2026 launches. In March 2026, Vanguard launched 3 new ETFs that give more targeted exposure. VTEC, global technology, excluding Australia. Think semiconductors, software, AI, higher growth potential, but lower dividend yield. VTKH, thematic tech, more concentrated, higher risk. And VIHY, international high yield shares. This one focuses on companies with above average dividends globally. Here's the rule. These are satellites, not your core. Don't put more than 10-20% of your portfolio into them unless you really know what you're doing. Property, infrastructure, fixed interest, specialized sectors matter too if you want diversification beyond shares. VAP is Australian property, A-REITs. Its benchmark is the S&P ASX 300 A-REIT index. Key risk, interest rates. When rates rise, property ETFs often fall. VBLD is global infrastructure, toll roads, airports, utilities. Defensive but not risk-free. VAF and VGB are Australian fixed interest government and corporate bonds. Always check the underlying benchmark on the fact sheet. Bonds can mean long duration or short duration. Property can be Australian only or global. Don't assume, read 6-step analysis framework. Now the most important part of this video, a 6-step framework you can use to analyze any Vanguard ETF, from VGS to the new VTEC. 1, benchmark. Is it broad or niche? 2, management fee. Lower is usually better, but not always. 3, returns. Compare after fee returns to the benchmark over 3 and 5 years. 4, top 10 holdings. If if the top 3 make up 40% of the fund, that's concentration risk. 5, fund size and age. Larger, older funds tend to be more liquid and stable. 6, portfolio fit. Is this fund filling a growth role, a defensive role, or just a speculative satellite? Write these 6 steps down. Use them every time. Let's put it all together with 3 example portfolios. For the beginner, just buy VDHG. That's 100%. No rebalancing, no stress. For the DIY growth investor, 50% VGS, 30% VAS for core Aussie and global exposure, then 10% in something like VTEC for tech tilt, and finally 10% in bonds like VAF to take the edge off. For the income-focused investor, 40% VAS for franked dividends, 20% VIHY for international high yield, and 40% in bonds, VAF or VGB for stability. None of these is correct for everyone. Your age, risk tolerance, and time horizon change the numbers, but the process stays the same.